U.S. employment rises far less than expected in the month of May to record its weakest reading since September last year. The U.S. jobless rate now stands at 9.1%. Also, high energy prices and the effects of the Japanese earthquake have bogged down the U.S. economy. For more on this, let's go straight across to Beth Ann Bovino, who's senior economist at Standard & Poor's. She joins us live from New York. Beth Ann, to begin with, the U.S. jobless rate now at 9.1%. I am disappointed. Are you?
Very disappointed. We had been expecting, our markets had been expecting about 8.9%, so the unemployment went the wrong way. And more importantly, the payrolls numbers at 54,000 was one-third what markets had expected. That 150,000 estimate was also earlier downward revised after the disappointing ADP report. So the numbers look really bad. It certainly adds some risk to the recovery.
Right, Beth Ann, it's also a sea of red that we are seeing in Wall Street today. What's your view on the overall economy?
Well, I think the readings, the numbers have been very bad for the last 2 weeks. We saw auto numbers, auto sales look disappointing. We saw construction and manufacturing be very weak. This all, of course, we can say it's tied to the Japanese crisis and the loss of supply materials, and also tied to weather. But there's only so many times you can say that. And regardless of those 2 points, we do think that GDP for the second quarter is going to be much sharper than we earlier expected, probably closer to 2.5% rather than the earlier 3.4% we had been estimating.
So right then, Beth Ann, the obvious question that comes to mind is whether this once again raises the prospect of a QE3.
Well, we think that certainly the good news, I guess, if you can find any, or the silver lining, is that these weak numbers certainly put some downward pressure on inflation. We're seeing oil prices coming down a little bit anyway, and that does in a sense give the Fed a little bit more wiggle room in terms of actually their monetary policy. Right now we don't think the Fed is going to want to move into a QE3. We think they want to stick to probably more traditional materials. Like, for example, we think the Fed may now want to keep interest rates at near zero, maybe longer than the raising rates at the end of the year, which we earlier expected. Might keep it actually into 2012. We also think that Fed may actually keep that huge balance sheet pretty much where it is for a little longer than they earlier thought.